In the meantime, remember that you can, let's just, I think I'm going to, in the meantime, remember you're welcome to engage with us via the Q&A. Right at the top of your screen, you'll see Q&A, so there you can engage with us. If you have any questions, as we said before the break, the session will be recorded, so there will be a recording, so if you do need to leave us for any reason, those recordings are on YouTube, and you will see during the break, I did post the link to that YouTube channel for you in our Q&A section. So that link is available now. And then also, please, if you can sign the register for us, then we're going to jump right back in. Okay, everyone ready? Can we get going again? Okay, thanks. And I see Salama was also able to assist a little bit. I believe some of the students are not able to join us this morning, so she was able to also put up some tips there to help everyone to join. If your friends are not able to join, then please also just remind them that there will be the recording that they can watch later. Okay, so before the break then, we said we're going to now start dealing with the accounting equation, and we're going to look at a set of transactions and how do they impact the accounting equation and how do they impact the general ledger. And I said also that from a first year accounting perspective, and certainly a first semester perspective, there's really only a handful of transactions that we can test you on, or that the majority of the test questions will be based around. And also when you do your textbook questions, you will be able to identify these 10 basic types of transactions. So that's why in our session this morning, I just want to make sure again that you're comfortable with this basic set of transactions and how they impact our accounting equation and also how they impact the general ledger. Remember again, in first semester accounting, we deal with our sole trader, so that single individual who wakes up one morning, has a fantastic business idea, and starts running a business. And again, you'll remember in Learning Unit 1, there's a section there that gives a short discussion on all the different kind of business forms. And it gives you a kind of a detailed discussion there on the sole trader. That's that section 1.4 in Learning Unit number 1. Okay, so before the break then, we said that when we have a transaction that takes place in the business, we're going to have the golden rule of accounting, which tells us that there must be at least 2 entries to record this transaction. And those 2 entries will relate to the accounting equation. So when we record the impact on the accounting equation, we must do at least 2 things. Okay, so we can't just increase the assets, we can't just decrease liabilities. There has to be 2 actions that happens in the accounting equation so that the equation will always stay in balance. And by staying in balance, I mean the assets must equal the owner's equity plus the liabilities. So after every single transaction, the assets must equal owner's equity plus liabilities. So that is then our golden rule of accounting. Every transaction needs at least 2 entries. But then we said, hang on, it can't just be any 2 old entries. It's 2 very specific entries that we're looking for. And one of these entries must be a debit and the other one must be a credit. And that's then where we look at the impact on the general ledger. So when I talk about these debits and credits, I'm talking about the impact this transaction is going to have on general ledger accounts. So let's have a look then at our first transaction. So this is a very common transaction when the business begins, or even if the business has been going for a while, the owner will contribute cash to the business. And if we then first up going to look at that transactions impact on the accounting equation, we immediately see up on your screen that there is definitely two entries. There is an entry under assets, there's an entry under owner's equity. So we've definitely done the golden rule of accounting. We have got two entries for this single transaction. And then to show the impact, we obviously have to show will the assets increase or will they decrease? Will owner's equity increase or decrease? And the same for liabilities. So in this particular transaction, then an owner giving cash to the business will have an increase, a plus under assets, and an increase plus under owner's equity. And please, it is crucial in your upcoming test that you must be showing us the pluses and the minuses. Okay, so please, it is very, very important that we as the markers must be able to see, did the assets increase or did they decrease? So please do not forget in the semester test to show us the plus and the minus. So now we've looked at this transaction's impact on the accounting equation. Now let's talk about this transaction's impact on the general ledger. Oh, yes, sorry. Before I get there, just a reminder again, if we talk cash, cash can be in the form of an EFT, it can be in the form of a direct deposit, or we can also talk about the bank account. So all your cash transactions will go into your bank. So your bank is your asset, and that is why we're saying the assets are increasing there. Please also just remember that, of course, in South Africa, we're no longer using checks. So particularly if you've got maybe older versions of our textbook, or if you're looking at very old past papers, they might still be talking about the owner contributes money using a check. Please just remember now in South Africa, it can only be cash or EFTs. Okay, so now we're going to talk about the impact of this specific transaction on the general ledger. And remember, we said, yes, we must have at least two entries, but there can't be any two entries. One of them must be a debit and the other one must be a credit. So now we're going to make sure that for this transaction where the owner gave us the cash, we have a debit transaction and we have a credit transaction. So when the owner contributes anything, we call that capital. And the capital account in the general ledger is going to be credited. And the bank account in the general ledger is going to be debited. So you can see we've got two entries. And yes, one of them is a debit and the other one is a credit. Let's just take one step back now again. Let's just make sure we all understand what do we mean by debit and credit? What do I exactly mean by that? Remember, where we talk debit and credit, we're talking about your general ledger accounts. So those individual accounts in the general ledger. And remember, there will be an account for every major group of transactions. So all of these names, if I can just quickly, if you can just bear with me a minute, if I can go back here. So this page 53, so there will be a general ledger account for each one of those assets, expenses, income and liabilities listed here on page 53. So for each one of those, we will have a separate little account. We refer to those as T accounts. And the reason we talk about a T account is because of the shape of the account. So can you see I've tried to highlight it for you here on my slide as a big red T. So we talk about these general ledger accounts as T accounts because of the shape of the account. And this general ledger T account has got two sides. The one side, the left-hand side, is the debit side, and the right-hand side is the credit side. So if I say a transaction needs a debit and a credit, what I mean is in the general ledger, you need to have two general ledger accounts. And for the one account, you're going to put the entry on the debit side. And for the other account, or for the other one, you're going to put it on the credit side. So if we go back here again, you will see then in the bank T account, I put the 500,000 rands on the debit side, and in the capital T account, I put it on the credit side. Of course, now our next question is, how do I know when must something go on the debit side and when must it go on the credit side? So the easiest way for you to remember that is to make use of this little acronym. And we refer to this little acronym as DEAD CLICK. So we abbreviate DEAD. It stands for we're going to debit expenses, assets, and drawings. So with other words, if an expense, an asset, or a drawing is going to increase, it must happen on the debit side. So if we go back here, then we see my bank is increasing because I said my assets are increasing with 500,000 rands, and therefore I've placed the entry on the debit side of bank. Then if I use my little acronym for the click side, it means I'm going to credit the increase for liabilities, income, and capital. So if any of those three groups of accounts increase, it's going to go to the credit side of the account. So if we jump back here again, we'll see, yes, capital is increasing by 500,000 rands. And how do I know that? I've put it on the credit side of the ledger account. So it's really important to remember that little acronym DEAD CLICK. Write it quickly down on your test paper, because that will help you so much in understanding, do I put it on the debit side or the credit side of a particular account? And for DEAD, it means increases goes debit. For CLICK, it means increases must be credit. I even let my students add the debits and the credits to page 53, because this then will make page 53 a summary in one page. So you can see here, I let them add that the assets are debit, drawings is debit, expenses are debit, because that's the debt part, and then the click part is the capital, the income, and the liabilities. So I would suggest you do the same with your page 53, and then you've got one complete summary there on one page. Okay, Salama, everyone still keeping up? Everyone doing well? Do you want to add in anything for our students?
Hi, Ina. Everything's fine. I think you answered one of, I think it was Nathan's question was, how do we know which transaction is debit or credit? So I did tell him about debt click. That's very important. I've got a question from Luyanda. When are we dealing with two assets? For example, in one transaction, how do we know which asset to debit and which one to credit? That was one of the questions. And then, can a debit have an amount that has a plus? This is from Michle.
Okay, so Luanda, I'm going to get to your question in a little while. One of the examples I want to show you is one where we have assets both increasing and decreasing. So hopefully that will answer your question. And then the one about, can a debit have an amount that has a plus? Remember, for an asset, if I write it on the debit side, that is the same as saying I'm adding to the asset. So instead of in the general ledger making pluses and minuses, so you can see there in my general ledger accounts, I didn't make, oops, sorry, this one has gone a little bit too far now. So in my general ledger accounts, you'll see I didn't put the pluses in front of the amounts because the debits and the credits now means the pluses or the minuses. Okay, so in the general ledger, we replace the plus and the minus with having the debit and credit transactions. Salama, any other questions or can we move ahead?
Let me just see. Can you please repeat the explanation about the general ledger? This is from Geneve. I don't know, is she, yeah, I think she wants you to explain when you did the posting to the capital and the bank. Or this, yes, this one over here. Yeah.
Okay, Genevieve, I hope this is the one. So remember, if we're talking, okay, so let me go back a step. So we said for every entry or every transaction, we need at least 2 entries, and it can't be any 2 entries. One must be debit and one must be credit. What do we mean by talking about this debit and the credit? We're talking about your general ledger. And remember again, in Learning Unit 1, they give us the definition of a general ledger. So in Learning Unit 1, they tell us a general ledger is a collection of accounts. So in the general ledger, we are going to have an account for every major group of assets. So for all of those little assets, income and expenses listed there on page 53, there's going to be a general ledger account for them. And a general ledger account has got 2 sides, the left-hand side being the debit side and the right-hand side being the credit side. And we're going to place our entries on either one of these 2 sides because these debits and credits actually also mean plus and minus. So for an asset, a debit means plus, but for a liability, income and capital, a credit means plus. And that's why you need to use your little dead click acronym to remember now, do I put the increase for this particular transaction on the debit side or do I put it on the credit side? We're going to do a couple more transactions. So hopefully as we do a few more of these transactions, then you will start getting the hang of these entries.
Hi, Ina. Georgia asked about the pluses and the minus, those signs. Would it be incorrect to put the sign in the general ledger? So I told her that we do not put the signs of the plus, by the amount in the general ledger. We only show that on the accounting equation for the impact.
Yes. Thank you for that. Yes, so for the impact on the accounting equation, you must show the plus and the minus. But remember, in the general ledger, the debits and the credits takes the place of the pluses and the minuses.
And then
Okay, so we've looked. Oh, sorry.
What if opening balances are included? How do we enter that? One of the students asked here.
Okay, so for opening balances, again, you're going to use your dead click. So again, for expenses, assets, and drawings, the opening balance and the increase always sits on the same side. And then with liabilities, income, and capital, again, the opening balance and the increase will be on the credit side. So opening balances and increases always sits on the same side. Okay, students, if you don't mind, I'm going to jump in with a few more transactions. I'm just a bit mindful that we will be able to cover everything in our allocated time. So the first type of transaction then that we looked at is the scenario where your owner gives cash to the business. But you'll also see in a lot of the questions, the owner don't give cash, but they could also give an actual asset to the business. So let's look at how we're going to record it then if the owner contributes an asset to the business. And in my little example, we're just going to say they are going to contribute a delivery motorcycle. So with other words, a vehicles to the business worth 25,000. So again, if we look at the impact on the accounting equation, assets still go up, owner's equity goes up. So the impact on the accounting equation looks exactly the same as if the owner had given us cash. So whether it's cash or an asset, the impact on the accounting equation looks the same. But when we now look at account debited and account credited, that's now going to be slightly different because instead of getting cash, we're now getting a vehicle. So we're still going to credit the capital account. So that is going to remain the same, the capital increasing on the credit side. But then we're going to have a vehicles account this time around increasing on the debit side. So instead of taking the debit to the bank account, this time around, we're going to take the debit to the account for the actual asset. So the asset can be office equipment, it can be machinery, it can be furniture. You would just need to look at the question in the paper. Salama, sorry, did you want to add something?
Hi, Ina. Just very important, usually with my students, is when I tell them to read the transaction, at the same time, I also tell them to identify already the two accounts. Okay, so for the example, when you see owner contributes or owner invested, then already you need to remember that has to do with capital, and then delivery motor vehicle has to do with vehicles. And the minute they can identify already those two accounts, they would then know that the one would be an asset and the other one would affect owner's equity. Okay, and that would also then help them to know where to actually put those two amounts on the accounting equation. Okay.
Oh,
And
excellent. Thanks. I'm so glad you actually raised that with the students. Sorry, were you still talking?
yes, and then also what I do is, unfortunately, I can't actually, I know we can't seem to write here, but I also tell my student to write the rules on top of their answer sheet. When they're answering the accounting equation, for example, they draw that little T account that says assets, and then on the debit side the plus, on the credit side the minus, and then for owner's equity also draw the little T there, and just remember what increases owner's equity, it's capital and income, so though that is your pluses, and what decreases owner's equity is your drawings and expenses, so that is your minuses. And then for liabilities also draw your little T account there, and then credit is plus and debit is minus. So on your answer sheet, just write that above when you're going to be answering this question, and it will make it so much easier for you to remember the impact. And also, the minute you put a plus, it will guide you as to know if a plus is for assets, then it means I need to debit the asset account. Okay, and if I said a plus for owner's equity, then it has to be a credit. That is why I will credit capital. I hope that will help, Ina.
Oh, excellent. Thanks.
Yes.
Yes, I think our students need all these little tips and tricks to make sure that they can do their best in our upcoming test. Oh yes, I also just wanted to add on to Salama's excellent point. So you need to really read your transaction carefully, because in the transaction, we've got to guide you as to which two general ledger accounts you have to use. So you have to make sure that you really read that little transaction very carefully, and often we already give to you in the little transaction the names of the accounts. You will see later, for example, if we say it's a cash sale, immediately you know one of the accounts must be sales And if it's cash, it must be bank. So in the transaction, we actually guide you to knowing which two general ledger accounts you should use. And again, if I'm talking general ledger accounts, remember these are the names that I'm looking for. These are general ledger account names. So in each transaction, you need to find two of these names in that little transaction. Okay, I see I now do have to just pick up the pace a little bit. Otherwise, our 3 hours are really, it's just running away with us. We're having so much fun. Right, so owner can give us cash or an asset, and we've looked at how we're going to do it both in the ledger and the accounting equation. Now, the next types of transaction is now the owner taking something out of the business. And again, it can be two things. The owner can either take cash from the business. So this would be an example of the owner taking out of the business. And remember, when the owner takes out of the business, we call that drawings. When the owner contributes to the business, that is called capital. And when the owner takes from the business, that is referred to as drawings. And here you can see our petty cash is an asset account, but our asset is going to get smaller because now the owner is taking money out of the business. And now you can see I've credited the asset account. And by crediting that petty cash account, I'm showing that the asset is getting smaller because the owner is taking money out of the business. Remember again, our accounting equation is the assets equal owner's equity plus liabilities. And Salama just touched on it a little bit earlier, where she just reminded you that owner's equity actually is made up out of 4 distinct elements. So owner's equity is made up out of the capital, which is what the owner puts into the business, either cash or an asset. Then there's our drawings, and that's the money or assets that the owner takes out of the business. There's also any income that the business earns, and there's your expenses. And all 4 of those together makes up owner's equity. So all of them, any transaction impacting capital, drawings, income, and expenses, all of them are going to sit under your owner's equity column. And just remember again that a fancy name for capital and drawings are the proprietary accounts. So sometimes in a test, we will say name the 2 proprietary accounts, and those would then be capital and drawings. Those are the 2 general ledger accounts that deal specifically with transactions with the owner. Remember, a proprietor is an owner, and that's why these 2 accounts are accounts dealing with the owner. Okay, so in the previous example, our owner took cash out of the business, but it is also possible that the owner can take asset from the business. For example, here the owner is taking inventory out of the business. So you can see once again the transaction looks very similar, but now instead of crediting petty cash, we're just going to credit the asset account inventory because the question says the owner is taking inventory. So again, you can see that the transaction actually leads you to the account names because we're talking about an owner taking something. So we immediately know if the owner is taking, that's drawings. And then what is the owner taking? Oh, yes, the owner is taking inventory. So you need to just make sure you analyze each of your little transactions and see, can I see the 2 general ledger accounts from the transaction? Just to remember, we spoke a little bit earlier about the 2 different inventory systems that we cover in first year accounting. And this particular way that I have recorded this transaction is for a business using perpetual inventory. So just be aware of it, that this transaction will differ slightly if a business was using periodic inventory. And remember again there in your textbook, page 70, that's where you're going to find that little table that is just going to give you the key differences between the two inventory systems. Okay, so now the next batch of transactions that we are going to look at is what now if the business buys either assets so mostly we're going to look in this scenario at the business buying assets, whether it's non-current or current assets. What will now happen? And when we buy something, we can either directly pay for it in cash, or we can say, okay, we're going to buy now, but we're going to pay later. With other words, we're buying on credit. So for the next batch of transactions, we're going to be buying assets. We're going to pay for them in cash. Then I'm going to show you if we pay for them on credit. And then, of course, the last thing that sits with it is how will we record it when we pay the creditor. So let's look at these three types of transactions. So the first one is now I'm buying an asset, a non-current asset, machinery, and I'm paying via EFT. Remember again in the test, if you see the words pay via EFT, in your mind, you should immediately translate that to bank. Okay, so an EFT payment is a cash payment, and so then the impact is immediately felt in the bank account. And I think earlier, some of you already raised the question, what do we do or how do we record it if our assets increase and decrease at the same time? So here is now an excellent example of that type of a transaction. And again, if we analyze the little transaction, we can immediately see the two account names. What did we buy? Machines. So the account must be machinery. That must be one of the accounts. How did we pay for the machine? Via EFT. So with other words, cash. Where do we keep our cash? In the bank account. So immediately we can see that this transaction must deal with two accounts, machinery and bank. Then our next question is now, what type of accounts are machinery and bank? And that's when your knowledge of this page 53, so if I can just go back there for the minute, that's where your knowledge of this page is now becoming so key again, because now you're going to say, right, machinery, let me have a look on this table. Okay, there it is under non-current assets. Bank, okay, where is it? There it's sitting under current assets. Okay, great. I can see I'm dealing now with two assets. So the impact on the accounting equation then must sit under the asset column. And this transaction is then one where we gain an asset. So our business is getting this machinery, but at the same time, we are also giving up an asset because we have to be paying with our asset bank for the asset machinery. So this one is your example, a very good example of where my assets both increase and decrease. And then if I'm using debt click, I know that an asset that increases is a debit. So the machinery account, I have to debit, but an asset that decreases will then be a credit. So I'm crediting the bank and I'm debiting my machinery. So they're both assets. We have an asset increasing debit, an asset decreasing credit. Okay, so we said different scenarios. We can either be buying an asset for cash, or we could be buying an asset on credit. So let's look at that transaction. Now in this one, if we're buying anything on credit, it means we must have a liability. It means there must be a creditor out there that we still owe this 5,000 rands to. So this one, yes, the assets are still going to increase because we're still getting an asset inventory. But the other side of this transaction is now sitting under the liabilities because we owe a creditor this 5,000 rands. And creditors, they sit under click. So a creditor is a liability, and liabilities increase on the credit side and assets increase on the debit side. So that will be how we will show the impact on the equation. And in the general ledger, if we were to buy an asset, it doesn't matter what kind of an asset, can be current or non-current, but an asset bought on credit will always have this impact on the equation. And in the general ledger, it will be the debit to the asset and the credit to the liability. Now, at some point, we have to pay the creditor. So now, oh, sorry. Just to, again, just to note, please, that this particular entry that I've showed you here, where we're buying the inventory, again, I have shown you the entry for the perpetual inventory system. And as we've said a few times now, you can go to that page 70 in your textbook if you want the detailed summary of the two inventory systems. And again, when we get to Learning Unit 6, so when I see you next in our preparation for Test 2, we'll also talk about these inventory systems in a lot more detail. Okay, so now we've bought an asset for cash. We've bought an asset on credit, and now it's time for us to pay the creditor. So we owe the creditor 5,000 rands, and now we need to go and pay that creditor. So in my little example, we're going to pay our creditor 3,000 rand. So we're just paying a part of the amount that we owe them. And now my assets are going to decrease and my liabilities are going to get smaller. So my assets are getting smaller because I have to use actual cash, take money out of the bank to pay the creditor. And my liability is getting smaller because now, instead of owing the creditor the full 5,000 rands, I'm now going to only owe them 2,000 rands because I'm paying back some of the amount that I owe the creditor. So in the general ledger, then you'll see there on the blue side, that's where we recorded when we bought the trading inventory for 5,000 rands. And now on the red side, on the debit side, now I'm making that payment to the creditor. So now you can see nicely, this is now a liability with the two entries. The credit side was the increase in the liability, and now the debit side, the red side, if you look at your slide, that's now the decrease in the liability. And my assets are also decreasing because remember, I'm taking the money out of the bank. I'm making an EFT payment to that creditor.
Hi, Ina. I have a question where a student is asking me if they only write like you wrote, account debited, creditor, or can they also write creditors control? I tell them both will be accepted. We will mark creditor and creditors control correct.
Yes, actually, strictly speaking, the student who said creditors control is maybe the best answer you can give us.
Also,
I'm always a bit limited for space, but certainly we normally, as the lecturers, we have a little bit of marking discretion here. So if you said creditor, we'll give you the mark creditors control. Same for debtors control. Also, if you use terms like trade payable, we will accept all of those terms.
thanks you, Ina.
Okay, so now we have looked at the owner contributing either cash or an asset. We've looked at the owner taking from the business. We have looked at buying assets either for cash or for credit. And now the next group of transactions that we're going to talk about is now our expenses. So if we are either, say, buying something like stationery, and we can either buy it for cash using either our petty cash or our bank account. Or we can also do our expenses. We can also buy packing materials or stationery on credit. So again, we're going to look at the two scenarios. Is it cash or is it credit? So in the first one, we're looking at an expense, wages paid via EFT. So again, if we just analyze that transaction, immediately we see we're paying wages. So we know one of the account names must be wages or salaries and wages, which we can also accept. And if we see it's an EFT payment, immediately in our minds we translate. We know EFT means cash, cash means bank. So by just reading that transaction, I'm already able to identify that I need to use two accounts. I have an expense and I have my bank account. And if I'm paying wages, it means my expense is going to increase. So I need to debit the wages account. And on the other hand, because I'm paying cash, it means my asset must decrease. So my asset's going to decrease and my expense is going to increase. But now, this is where students sometimes get a little bit confused, because if you now look at the impact on the accounting equation, this can now sometimes become a bit of a problem. So I'm sure you're all happy to see I've made a minus under assets, because we're all in complete agreement that my assets are decreasing, I'm paying via EFT. But you'll see there's also a minus under owner's equity. And sometimes this is where students get a little bit stuck, because they will argue, but if my wages or my expenses are increasing, why are you saying minus owner's equity? But remember again that our owner's equity is made up out of four things. And included under owner's equity is both income and expenses. And when we talk about income and expenses, we look at their impact on owner's equity. Because remember, again, we have our little sole trader here, that single business owner. And the single business owner will take all the profits made in the business, or they take the losses that's made in the business. So if we are paying for expenses, if we're incurring expenses in the business, it means that the owner's profits will be less. Because remember again, profit is calculated as income minus expenses. So when I show the impact on the accounting equation, I'm showing the impact on the owner's equity. So even though the expense is increasing, the impact on owner's equity is that the owner is going to have less profits to take home because they had to pay wages of 4,500. So just make sure for this one that you just have a look at the owner's equity, that it's minus. And of course, if my assets are minus, then my owner's equity must also be minus. Otherwise, my equation won't be true, because I must be able to say minus 4,500 equals minus 4,500. So in this scenario, then we looked at an expense paid in cash. So let's just look at how will the transaction differ if we now have expenses, but we've bought it on credit. So for example, we bought some office refreshments, but instead of paying it in cash right there on the spot, we've said, no, 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 we will pay you at the end of the month or at the end of next month. So this one is also one of the interesting little transactions, because this is one of the few examples where we have everything happening on the owner's equity and liability side. So nothing is happening to assets at this point. We're only dealing with an expense, and the expense sits under owner's equity, and we're dealing with a liability, the creditor. So we're having our liabilities increase and our owner's equity decrease, and that equals the zero under assets. Again, in the general ledger, it's going to look like this. So we know in terms of dead click, that means expenses will be debited when they increase. So you can see there at the bottom on the pink, on the red side, my expenses are being debited. And then my liability, the creditors control, I'm going to use click. And there, if I want to increase a liability, I put the entry on the credit side. Okay, so this is the scenario then if we were to buy any of the expenses like the refreshments, the stationery, the packing materials, anything like that on credit. Okay, everyone keeping up? I know we're going a little bit fast, so you may need to re-watch this recording maybe at your own speed, which will allow you then to pause the video just to make sure you are understanding all of our entries. I hope you're all still keeping up. Salama, anything still there from your side?
Hi, Ina. I'm not sure if you just need to maybe remind them that when they are doing their posting to the T accounts in the general ledger, the cross-referencing with regard to the contra account. For example, when we're doing the entry for refreshments on the debit side, because we're doing the debit entry, we write down the contra account of the credit entry, which is creditors control. Okay, and when they're doing creditors control, they have to write down the debit entry account's name, which is refreshments. I'm not sure if you actually explained that to them, the importance of not writing creditors control, creditors, but they're always writing down the cross-referencing is always the contra account, the other account's name.
Excellent. Thank you for that reminder. Actually, I haven't mentioned it. So yes, thanks for reminding our students of that. Okay, so the next group of transactions that I want us to look at is now when we are selling anything. So we're going to look at what happens when we sell goods or services. And most of my examples are when we're selling inventory. So now we're going to sell inventory. Again, it can be sold either for cash, so impacting the bank account, or we could be selling on credit. So with other words, we could have a debtor, someone who is still going to pay us in the future. So again, we're going to look at this as a batch of transactions. So we're going to do a cash sale, we're going to do a credit sale, and then once we've made that credit sale, then of course at some point in the future, the debtor must come and pay us. So we'll also just group that together with the transactions. I know time-wise, we are coming up to our next break, but if you'll just bear with me, I just want to finish up the accounting equation before we take the break. I'm not forgetting about the break. I know we all need a leg stretch, believe me. But if you'll just bear with me, I'll give you the break just once we've done this, this section of the material. Okay, so we're going to look at our sales. We're going to sell for cash. We're going to sell on credit, and our debtor is going to come and pay us. Okay, so the first one here then, I'm selling on credit. Again, if I analyze that transaction and I'm looking for my two account names, if I sell, it must be sales. And if I'm selling on credit, it means I have to have a debtor. Or, as was correctly pointed out earlier, I must use debtor or debtor's control. Or you can say a trade receivable. Okay, so here again, it's important to note which inventory system is being used in the question. And the way I'm going to show you the transactions now is again specific to the perpetual inventory system. So first, I'm recording the actual sale at the selling price. So we're selling it for 5,000 rands. Our income is increasing. That happens on the credit side. And our asset debtors control is increasing. And that happens on the debit side. But because we're dealing with the perpetual inventory system, there's also a second set of entries that has to be made, because we also need to be updating our inventory, because now we've sold some inventory to this debtor. So we need to be making sure that we're now taking that inventory out of our inventory account, because we can't sell it again. It's now gone. It's gone with the debtor. And that's why in the question we gave you the selling price as well as the original cost price of the item. So first, we're going to record the actual sale, but because it's perpetual inventory, we also need to be recording the cost of that sale. And cost of sales is an expense account, so it increases on the debit side. Inventory or trading inventory is an asset account, so it decreases on the credit side. So this is the second part of that entry for the credit sale. Now, when we make, did I not actually, sorry, I thought that I had, it seems like I don't have the cash sale. If we were to have done a cash sale, so if this was exactly the same set of information, but they just told us that we made a cash sale, then our entry would look exactly the same, but instead of debiting the debtor, we will now just debit the bank account. So if this exact same entry was a cash sale, you would only make one change to this entry. Instead of having a debtor, you would have bank. The rest of this entry will look exactly the same, including the cost of sales entry as well. So this entry will still be made irrespective if it's a cash or credit sale. The only proviso is that we must be using the perpetual inventory in that particular question. Now our debtor owes us the 5,000 rands, and so at some point they're going to come and pay us. And then we're going to have that scenario again where we have the assets both increasing and decreasing. Our assets are going to be increasing because we're going to get 5,000 rand in cash from the debtor. But at the same time, the asset called debtor is going to be decreasing. And if you look at that little middle account, that middle account for the general ledger, the debtors control, you will see it nicely there. The original sale was recorded on the debit side. And then when our debtor comes to pay us, we record that on the credit side. And you'll see once we've recorded that, then it shows now the debtor isn't owing us any money because they owed us 5,000 rands and they've paid us 5,000 rands.
Hi, Ina,
Oh,
could you sorry, I had a question where a student asked, please could you mention that the left-hand side equal the right-hand side? I think that is something I always stress to my students when doing the accounting equation. Always check after each transaction that the equation balances. For example, if they had to put the minus 2,500 of the asset amount into the liability section, then the equation would not balance. So it's always important for them also to always note that the left hand side, which is the assets, the amounts that you're recording on the left hand side must equal to the right hand side. That will also guide them to know whether they are doing the impact correctly.
Oh, thank you, Saloma. That's an excellent reminder. And yes, I'm so glad you've stressed it. And the student can also see there up at the top, I've tried to show you the actual equation that your assets must equal owner's equity plus liabilities. And as Saloma pointed out, it's so important to check that for every transaction because then you may pick up little errors then that you can quickly correct before handing in your paper. Just for the sake of time, I'm not going to show you the cash sale because we have spoken about that. Let's see. So just to recap then so far on our exam tips, is that stay on time. Okay, so please make sure you're not exceeding the time for that question. Make sure that you're reading carefully. For example, in these types of questions, make sure that you check carefully. Is the question only asking impact on the equation, or is it asking impact on the equation and impact on the general ledger? So please make sure that you are actually answering us answering what we are asking. Because if you're doing too much work, then of course you're going to run out of time. If you do too little work, of course, then you're not going to get all your marks. So again, that's what brings us back to make sure you read your required and understand exactly what we want you to do. Then the next thing is show us your workings. I've now skipped over the slide where I wanted to show you this, but when we get to learning unit number 3, in the next 10 minutes or so, I'll talk a lot more about this thing about showing workings. But certainly, even here in the accounting equation type questions, if we're talking about a markup percentage or a gross margin that's being used by the business and you need to calculate your cost of sales, then please make sure that you are showing us all of those workings. But we'll speak a lot more about markups and gross margins in our next session. But the key takeaway point here is just if you have to make any kind of a calculation, even as part of your accounting equation, then please make sure you're showing those workings. Okay, the last possible type of transaction I just want to cover quickly is we getting a loan. For example, the business gets a 20,000 rands loan. Money goes straight into the bank, which is the asset, and we'll have a loan account, which is the liability. Then at some point, we also need to pay back the bank for that loan. And here on this slide, I've just shown you the contrast between the two transactions. So at the top in the green block, that is where we obtain the 20,000 rand loan, assets plus, liabilities plus. And then in the bottom, more purple colored block, that is just when we repay the loan. And so now it's assets minus, liabilities minus. So in a nutshell, those are sort of the 10 most commonly asked transactions. And if you can get your mind around those transactions, then you'll see that there's not much more that we can ask you, or too many other types of transactions that we can ask you that doesn't sit within those 10 transactions. And then this is what Salama was also just reminding of us of a little bit earlier, that after every transaction, you must double check and you must make sure that your assets are actually equal to your owner's equity plus liabilities. So in other words, what the business owes to third parties, like the bank and the owner, must equal what the business owns in terms of its assets. Okay, I'll give you your break in a minute. Just if you need more video clips, then remember also the resources on ARC. So if you go into ARC, into content, into learning unit number 2, you will find there is a nice little video there that just deals again with double entry accounting. So there's something else you can watch to prepare yourself for the test. And again, under ARC, there's another little short video on debits and credits. So if these are two topics that you feel you can still do with a little bit of extra help, then please go and access those ARC resources and watch these 2 videos. So I think I'm just going to give us a little break now at this point. So again, we'll have our 10-minute break. So please, if I can ask everyone to be back in the venue by 10 minutes past 10, so that we can just quickly wrap up learning unit 2 and then move over to another important learning unit number 3. So we're going to take our 10-minute break now, and Salama and I will see you back in the venue at 10 past 10. Thanks, everyone.
10 past 11, Ina. 10 past 11.